The wealthy pay less in tax than you, not by accident, not by cheating, legally, using rules that have always been there, written into every tax system on earth. Rules that nobody taught you. Rules that your employer, your bank, and your government never advertised. Today, I am going to show you exactly what those rules are. Taxes are the single largest expense most working people will ever have. More than rent, more than food, more than school fees. And yet, most people spend zero time learning how to legally reduce them. The wealthy spend enormous time and money on exactly this. That gap in attention is the gap in their bank accounts. Here is what we cover today: how the tax system actually works and why it rewards certain behaviors. The legitimate deductions most people never claim. How the wealthy use business structures to legally reduce their tax burden. How investments are taxed differently from income and how to use that. The Tanzania and East Africa tax reality, and the mindset shift that makes all of this possible. Stay until Chapter 6. That chapter is the one that changes everything permanently. Before we dive in, drop a comment, just one number. What percentage of your income do you think goes to taxes, directly and indirectly? Most people genuinely do not know. And not knowing is exactly why they overpay. Drop your number. Let us begin. Most people think the tax system is neutral. It is not. Every tax system in the world was shaped by the people who had the most to gain from shaping it. Business owners lobbied for business deductions. Investors lobbied for lower capital gains rates. Property owners lobbied for depreciation allowances. The result? A system that rewards certain behaviors, and those behaviors happen to be the ones the wealthy were already doing. There are two types of income in almost every tax system: earned income, your salary, and passive or investment income, dividends, rental income, capital gains. In most countries, earned income is taxed at the highest rate. Investment income is taxed at a lower rate, or sometimes not at all. The wealthy know this. That is why they convert earned income into investment income as fast as possible. The progressive tax system punishes earning more, but rewards structuring more. A person who earns 5 million shillings as a salary pays a fixed rate. A person who earns the same 5 million through a registered business deducts legitimate expenses first, then pays tax only on what remains. Same income. Very different tax bill. The difference is structure, not income. Here is the most important principle in this entire video. The tax system does not punish wealth. It punishes certain ways of earning, and it rewards others. Your job is to understand which ways are rewarded and move your financial life toward them. This is not evasion. This is not fraud. This is using the system exactly as it was designed to be used. A tax deduction reduces the income that tax is calculated on. If you earn 5 million and claim 1 million in legitimate deductions, you pay tax on 4 million, not 5. That difference, multiplied across years, is enormous. And most people leave enormous deductions unclaimed every year. Not because they are not entitled, because they do not know they exist. Deduction 1. Business expenses. If you have a side hustle, which you learned about in Project 6, the costs of running that hustle are deductible. Your phone bill used for business, internet, transport to client meetings, equipment, software subscriptions, a portion of your home if you work from there. These are legitimate business costs. In most tax systems, they reduce your taxable income before tax is calculated. Deduction 2. Retirement and pension contributions. In many countries, money you contribute to a registered pension or retirement fund is deducted from your taxable income. You save for your future and reduce your tax bill today, simultaneously. This is one of the most powerful legal tax strategies available to ordinary workers, and most never use it to its full potential. Deduction 3. Investment in productive assets. In Tanzania and many African countries, investments in certain productive sectors may attract tax incentives. Agricultural investment, manufacturing, export-oriented businesses, special economic zones. The government uses the tax system to attract capital into priority areas. If your business or investment qualifies, you may pay significantly less tax by design. Here is where the real gap opens, between those who earn as individuals and those who earn through structures. A registered business is not just a legal entity, it is a tax tool, one of the most powerful ones available to anyone. And in Tanzania, registering a business is far simpler and cheaper than most people believe. When you earn through a registered business, you spend before you pay tax. The business buys what it needs, pays legitimate expenses, pays employees. Then what remains is the profit. And tax is calculated on the profit, not the total revenue. An individual earner does the opposite. They earn. They are taxed on the full amount. Then they spend from what is left. The sequence makes an enormous difference. The Tanzania Revenue Authority recognizes multiple business structures: sole proprietorship, partnership, limited company. Each has different tax implications. A sole proprietorship is simple but offers less protection. A private limited company, TBL, Ltd, offers separate legal status, different tax treatment, ability to retain earnings inside the company and only pay personal tax when you extract them. This timing flexibility is a powerful tool. Income splitting, a legitimate strategy used by family business owners worldwide. Instead of one person earning everything and being taxed at the highest individual rate, income is distributed across family members who each have their own tax threshold. A husband and wife both working in a family business, each earning a salary, each using their own tax-free threshold. Together, the family pays far less tax than if one person earned it all. Here is the tax truth that changes how you think about investing. In most countries, money that works for you is taxed differently from money you work for. Capital gains, the profit you make when an investment grows and you sell it, is typically taxed at a lower rate than your salary. Sometimes significantly lower. Sometimes not at all if held for long enough. Dividends, the income paid by companies to shareholders, also often receive preferential tax treatment. In Tanzania, dividend income from listed companies on the Dar es Salaam Stock Exchange may be subject to withholding tax at a fixed rate, which in some situations is lower than the personal income tax rate the same amount would attract if it were salary. This is the system rewarding investment, exactly as it was designed to. The hold period matters. In many tax systems, assets held for longer periods attract lower capital gains tax or qualify for exemptions. This creates a powerful alignment. The tax system rewards patient, long-term investing, exactly the behavior that builds the most wealth. Selling quickly? Higher tax. Holding for years? Lower tax or none. Patience is not just a wealth strategy. It is a tax strategy. The primary residence exemption. In many countries, when you sell the home you live in, the capital gain is either tax-exempt or significantly reduced. This is the government saying, we want people to own their homes, own yours, live in it. And when you eventually sell, you keep most of the gain. This is a direct tax benefit available to every homeowner. And most renters are giving it away by not owning. Let us get specific, because the general principles matter, but you live and earn in a specific place. Tanzania operates under the Income Tax Act and is administered by the Tanzania Revenue Authority, TRE. Understanding how TRA actually works, not just in theory but in practice, is the foundation of every legitimate tax strategy available to you. In Tanzania, individual income tax is progressive. The more you earn, the higher the rate on the top portion. But, and this is critical, it is only the top portion that is taxed at the highest rate. Not all of it. Most employees overpay in their minds because they imagine the highest rate applies to everything. It does not. Understanding your actual effective tax rate versus your marginal rate is the starting point of every legitimate strategy. Skills Development Levy, NSSF contributions. The VAT system. These are taxes most employed Tanzanians pay but few understand deeply. Every month, NSSF contributions reduce your taxable income. But many employees do not claim this correctly on their returns. If you are self-employed, your NSSF contributions are deductible. If your employer pays on your behalf, it is part of your compensation package. Know what you are paying, and know what you are entitled to claim. VAT registration threshold. In Tanzania, businesses below a certain revenue threshold are not required to register for VAT, but businesses above the threshold must register and can also claim back VAT on their business purchases. Understanding whether your business should register voluntarily or mandatorily, and how VAT input credits work, can change your cash flow significantly. This is not theory. This is operational tax management. The Zanzibar dimension. If your business operates across both mainland Tanzania and Zanzibar, the tax jurisdictions are separate. Zanzibar has its own revenue authority. Different rates in some areas. Different incentive structures for tourism and trade. For businesses with operations on both sides, understanding which jurisdiction applies to which income is not optional. It is the difference between compliance and penalty. Before we close this chapter, the real gem hasn't even dropped yet. What comes next could completely change the way you see money, side hustles, and building wealth. In the next video, we're going deeper, smarter, and more practical. I'll show you the exact moves most people ignore until it's too late. So don't disappear into the internet jungle. Make sure you watch part 2 right after this, because that's where the puzzle finally connects. See you in the next video.